I view the markets as fundamentally broke. Like the number
Fundamentally broken. That's a big statement.
Yeah, there's value is just not a consideration for most investment money that's out. There's all the machine money and algorithmic money, which doesn't have an opinion about value. It has an opinion about price. Like, what is the price going to be in 15 minutes? And I want to be ahead of that.
Coming up on today's show, the S&P hits 5,000 for the first time ever, with investor sentiment reaching records. Why David Einhorn says the market is broken. Is inflation coming back? Cocoa and oil ripping higher. PayPal and Pinterest dive after earnings. And corporate insiders sell in mass. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. I'm your host Jared. Thanks very much for tuning in today. I'm going to let you know everything that's happening across financial markets. And there we have it. We just kissed 5,000 on the S&P 500 for the first time ever in late afternoon trading today. Just going down to a 5-minute chart, we got within a fraction of it yesterday at 3 p.m. And it was actually in the last 5 minutes of trading today. We crossed 5,000 for the first time ever before pulling back a bit and closing just underneath it. I actually saw a bit of improvement in breadth today. It was actually the Russell 2000 small caps, the leading index, up 1.5%, along with mid caps flirting with highs up almost 1% today. And for a change, it was the Super 6 tech stocks actually collectively falling lower. That was thanks to a soft fall in Apple, Amazon consolidating a little bit, and the big fella Nvidia, the weakest of the bunch. However, we still got a lot of stocks out there ripping, like Super Microcomputer, finding new highs again above 710. Another good day for Planetaire, up 3.8%, briefly getting above $25 a share. Got a huge rip in Taiwan Semiconductor Manufacturing, up 7%, and an absolute blowout from ARM Holdings, which at one point today was up over 60% and finishing the day almost 50% higher after they surprised on earnings, coming a bit higher than expected. And just a sign of the craziness going on in this market at the moment. The market cap hasn't updated here on TradingView. However, you can see there's a little over 1 billion shares in the float, and we're currently trading a bit above 116 after hours. So it's about a market cap of $116 billion, and that is purported quarterly revenue of $824 million. So if you extrapolate that to a year, it's about $3.2 billion with $116 billion market cap. That's about a price to sales ratio of 36, which is absolutely insane. Just to put it in some context and numbers we can kind of understand, imagine your favorite local restaurant does $1 million a year in annual sales. That's not profit. Out of that $1 million in annual sales, it might only do 100, 200,000. If it's really good, 300,000 in profit. So imagine your local restaurant does 1 million in annual sales. And even if it's a great restaurant, it's growing really fast. Would you pay $36 million for that restaurant? What sort of growth would you need going forward to justify that? To pay $36 million for a business that's currently only making $1 million a year in sales. Well, that's what's going on in the stock price of ARM Holdings right now. And just shows you how confident, optimistic investors really are out there. And we can just see that in the options market as well. Pretty heavy day of trading for a Thursday, coming in over 40 million contracts traded, 60% of them calls. Just shows you how lopsided the market is there. With almost half the options set to expire in the next 5 days, and 67% of options expiring in the next 10 days, with about half of all volume done by small and retail traders. And they're piling into things like Meta, only 22% put call ratio today, Nvidia at 40%, Taiwan Semi at 20%, and others like Super Microcomputer still really low put ratio at 38%. And so just going back to the chart at S&P 500, even though it doesn't feel like it, it is a bull market, can't argue with the technicals. Like I always say in this channel, price leads, fundamentals follow, and there's nothing more bullish than hitting all-time highs. That's because anyone that's long, at least in the S&P 500, is above water. Everyone's in the green, feeling good, wants to hold it and see how far it can run. And the market's been in that mood for about a couple of months now. You can see that in the Fear and Greed Index, in the extreme greed zone at 77, exactly where it was a month ago. You can also see that in the AAII Investor Sentiment Survey, approaching yearly highs in bullish readings. Same with active investment managers, with sentiment readings nearing highs for them as well. There's just one issue: corporate siders are taking the other side of this trade and have been doing some record selling versus buying. Looking at that ratio over the last couple of months, they're just simply not showing up and buying here. However, they're still offloading stock whenever the market's popping up. And we're seeing some analysts that track corporate insiders saying things like the cautionary signals are off the charts. That's Michael Brush. Said he's tracked inside activity on a daily basis for more than 2 decades, and he's rarely seen such a dearth of actionable insider buying. Going on to say, investors and traders take warning. The market looks vulnerable to a pullback. And that's because insiders are on a buyer's strike, and insider selling has ramped up dramatically in tech. They're taking profits into the big tech gains last year and so far this year, possibly expressing skepticism about artificial intelligence bubble. And just last week, the Vickers Insider weekly 1-week sell-buy ratio was extremely elevated at 8.46 for NASDAQ issues. And to put that in context, this gauge is bearish above 2.5 and bullish below 2, with analysts saying they are now disturbingly high. And we have seen this before, as insiders have a pretty good track record buying the dip, selling the rip, going back to the late 90s and the last NASDAQ tech bubble. We saw some key insiders offloading stock, with one of the biggest being Bill Gates, who at the time was leading Microsoft. He was offloading billions of stock going into the peak of 99, early 2000. Same with a bunch of other insiders at Microsoft, like Paul Allen, one of the biggest tech guys back then, Michael Dell of Dell Computer, offloading stock. And so just looking at a long-term monthly chart of the NASDAQ, we know we're breaking out to new highs. It's very difficult to short here in this kind of momentum train. Best is to stand aside and wait for at least a good topping pattern, if not gradually add hedges. But zooming out with all these insiders selling up here, could this possibly be an extended double top? Or could we possibly be forming a head and a head and shoulders pattern that could go on for a couple more years yet? Because looking at the last time we got that big peak in markets in the late 90s, a lot of people forget. Going forward, that was a lost decade for US stocks. It's actually longer than a decade. It took to 2013 before the S&P broke out to new highs again, and it was much worse in the NASDAQ, with stocks having a peak to trough drawdown of over 83%, even worse than a lost decade. And it wasn't until actually in 2017 the NASDAQ broke out to new all-time highs again. And so the market has a long-term tendency to do this. We'll go into a secular bull market like we saw in the 1950s going into the 1960s. And it kind of gets ahead of itself and can go a long period of time of consolidation like it did in the 1970s as well. That was another lost decade for stocks. And it's going back even further on the oldest stock index in the world, the Dow Jones Industrial Average, which has always been designed to have 30 blue chip stocks representative of the US economy. That too had a good bull market in the 19-teens going into the roaring 1920s. The big crash in October 29, and again, that was worse than a lost decade. Dow Jones Industrial, back in the early 1930s, actually had a peak to trough drawdown of almost 90%. How hard it must have been to hold stocks back then. And again, it wasn't until many, many years later before it made new highs. In fact, it was 1955 after peaking out in 1929, and even longer if you were to adjust for inflation. However, even the Dow Jones Industrial now has been in a very smooth uptrend for a long time. A lot of people who trade and invest today and in their careers, all they know is a secular bull market and assume it will continue and continue. However, we've got others like long-time billionaire hedge fund manager David Einhorn saying passive investors have fundamentally broken the market. The value industry has gotten completely annihilated. He said fewer traders are paying attention to a firm's fundamental merits as passive investment has taken over. Overvalued equities are gaining the most as traders mainly chase after price. And he's not wrong. That's been one of the biggest dramatic changes in the investing industry over the last decade. We can see that best in the total assets under management of ETFs. 20 years ago, it was only 151 billion, and it's just been on a huge steep ascent ever since then. And this chart's actually a little bit out of date, showing at 6.4 trillion. It's actually exploded in the last couple of years to 11.6 trillion assets under management, coming from just 150 billion 20 years ago. And that's because of a mass exodus from active fund managers that haven't been able to keep up with S&P 500, and a lot of people just pouring into index funds. And it is an area of controversy in the market how big and dominant these passive index funds are for a number of issues, with Vanguard, State Street, and BlackRock almost having a monopoly on the whole industry. They really influence corporate governance, setting ESG standards, pretty much telling companies what to do so they can be included in their indices, which management, being driven by shareholder returns as number one priority, are going to do. And some activist investors like David Einhorn and others have argued this is not in the best long-term interests of shareholders or society as a whole, as it kind of just rewards companies based on their size regardless of what's going on. It's kind of all weighted to market cap and piling on into the biggest stocks more and more. And so it's going to be interesting to see how this plays out in the long run, this big shift to passive index funds, and whether the S&P 500 continues to really outperform active managed funds, or whether active can make a comeback. But for now, more than ever, we've got the S&P and NASDAQ just dominating it, thanks to those biggest stocks up the top, just ripping to new highs. And just going back down to the daily on the S&P 500, and why the market's rallied so much since we bottomed down here in late October. And that was a bit of a pivot from the Fed. Jay Powell, who'd been hawkish all year, came out all of a sudden and said, actually, we can start cutting rates next year, which lit a fire underneath the market that is still burning today. However, it's possible that could be reversing, and we still can't entirely rule out the possibility the Fed actually raises rates again before it cuts, which would upset the narrative quite significantly. We've already seen a hot jobs market, hot retail sales, and now with risk assets ripping to new highs, unemployment at record lows. I'd say Jay doesn't want to cut because he's worried about reigniting inflation again, have an egg on his face, just like central bank in the 1970s did when they made their huge mistake. That's why we got some like long-term market veterans. Gary Schilling says the S&P may crash 30%, a recession will hit, and Bitcoin and AI are both overhyped. Said stocks are very expensive and very distorted. He compared the huge weighting of the Magnificent Seven in indices today to the Nifty 50 group of stocks in the 70s. High-flying members like Kodak and Polaroid, which eventually went bust. Going on to say when people focus on a very narrow segment of the stock market, they in effect are saying the rest of the stock market just isn't of interest and probably in trouble. And so Gary has a pretty good track record of making several correct market calls over the past 40 years. And now he's pointing to excessive speculation in the market. And so just looking at the chart of the Super 6 stocks here, because we've got the rest of the market kind of underperforming, most stocks are kind of going nowhere. And then so people see that. And normally in a real broad bullish market where things are going up here, there, everywhere, just easy to jump onto something. So people are only seeing these stocks work, and that's creating kind of a pile-on effect because there's not much else working in the market except for these big stocks and probably a handful, dozen or so of others like Supermicro Computer and a few others really ripping here. And so you got to remember in bull markets, even in individual assets or sectors, they end with a bang, and a lot of the price gains in the entire bull market can come just in the last 10% of the actual bull market length. Got Supermicro up over 160% year to date and just has all the characteristics of getting into a late stage speculative bubble. And so even though the fundamentals are strong with these businesses right now, the only thing we can be sure of is change, and markets have a tendency to get ahead of themselves, just like they did in the late 90s. All those people buying tech stocks in the late 90s excited about the future of the internet and how it was going to revolutionize the world. They were all right, they were correct on the fundamentals. However, they just ignored valuations. A lot of people said back in the late 90s, valuations don't matter anymore. We're in a new paradigm now where the internet changes everything. However, they were in for a rude surprise when the Nasdaq did sink over 80%, even though the internet did change the world and revolutionize everything. So no doubt, AI is revolutionizing things. It's definitely here and to stay and real in our society. However, is the market getting ahead of itself in valuations? We've got Nvidia now with a market cap of 1.7 trillion, that's 1,700 billion, and they made less than 20 billion in the last year. And so we're going to see tomorrow some figures from the Bureau of Labor Statistics recalculating their inflation figures over the last year with their revisions, and it's possible they revise upwards bit hotter than expected. And we saw that in the last couple of months of 2022. The difference between the original reported numbers in CPI versus the revised ones kind of trended up a bit there. And so we could possibly get a surprise in the upside with inflation. We do have some ingredients there for it. And looking back in history, no one's really accurate at predicting interest rates, not even the Fed, including investors. We can see this in this chart here of the effective Fed funds rate and what market expectations were for the fund rate at that time. And so you can see back in 2009, 2010, all the way up to 2016, investors were pricing in increases in rates like the Fed probably should have done. However, the Fed kept them at rock bottom low and lit a huge fire underneath the everything bubble. They kind of priced it right in 17, 18, got it heaps wrong in 21, 22, thought we're going to stay flat for a while. Even the big banks did. That's why they bought long-term bonds. Fed shot rates up in the most aggressive Fed hiking cycle ever. And here we are now, the market expecting the Fed to pull rates down to about 3.5% come end of year, which may not be possible if we keep seeing the primary inputs into a lot of our goods and services that we consume keep ripping higher, like cocoa. Get ready for your price of your chocolate to go up soon, with prices having doubling during the past year, hitting an all-time high, along with probably the biggest input into inflation, crude oil, getting back above $80 a barrel, as what's going on in the Middle East isn't going to go away anytime soon. And there's a look at a monthly chart of cocoa, just in a parabolic uptrend, and just looking at the daily chart of crude oil futures. Pretty good rip here today, up 3.2% on volume, and looking like we may have found a bit of a bottom here, or at least a strong bid in the market, given the tail risk coming out of the Middle East. And so even though we're in a technical bull market, who knows how high prices can go. If you're worried about what the coming years hold for the stock market, and we get a big reversion to the mean and valuation, you want to know how to really diversify and properly spread your wealth and protect your wealth, well then you're going to find a lot of value in my new online course called Trading, Investing and Wealth. Master the markets to achieve your independence. And I don't just go into the technicals and fundamentals and everything I've learned in over 20 years of trading and investing, 15 years for myself and working at an investment bank. I also talk about wealth, how to best accumulate it, spread it out, and protect it, and just some general rules and tips and things I've found of use on how to manage your wealth and think about it holistically. And I'll let you know specifically how I'm achieving that with my own wealth and portfolios, and showing you the trends and markets I'm invested in, letting you know the specific stocks and ETFs that I hold for the long term, in addition to going into all my active trading and investment strategies. So I'm really excited to launch my first ever online course this coming Monday night on the daily show that you're watching now. So if you haven't already, hit that subscribe button, and I'll let you know how you can get immediate access to my online course with over 12 hours of content, stuff I've never shared or talked about on this show, and I'm going to offer a big discount to you guys for the first week as well. And I guarantee you this will be the best trade you make all year, because you're either going to gain a lot of value, insight, and new strategies, or I'll give you your money back. So that's a risk-free upside trade for you, and I'm really excited to launch this in just a few days from now. So make sure you come back to the channel on Monday night for this. And just moving on with the show, looking at a few earnings we got out as we head into the back end of Q4 earnings season. We've got PayPal in more trouble. This stock has been a dog for a couple of years now. Analysts lowering estimates again after giving weak guidance, and them announcing they're going to lay off 9% of their workforce. Big trend in the tech industry, laying off a lot of staff. Some are doing it because they can squeeze higher profits. Others, like PayPal, are doing it because they're seeing a bit of trouble and not really meeting street expectations. Even though they reported a little bit better than expected, they only expect to post adjusted earnings in 2024 roughly in line with the same profit they got last year of $5.10. Analysts had been hoping for about $5.50 in guidance for this year's earnings. That's why we got the stock price tanking today, down over 11%. And there's a look at the monthly. This thing has not recovered like the rest of the tech sector has after its nasty 2022, with the stock price still down over 80% from those highs back in mid-21. And just speaking for myself personally, I've used PayPal for about 17, 18 years now. However, I've switched to others, and for the Click Capital business, I still offer PayPal as an option. However, most people I've noticed prefer to pay with credit card through Stripe. And so that's where I do most of my business with now, is Stripe. And I can just tell you from a user of a PayPal business account, their user interface and functionality has really gone towards developers. Now it's not really user friendly for most people. I find Stripe to be a lot better. And so even though PayPal still process a lot of online payments, they've just got competition out the wazoo. Not to mention, they upset a lot of people 2 years ago trying to enforce some woke policies on us all. Even talked about creating a social credit score and things like this, which they quickly backtracked, and then the problems have just persisted ever since then. So I'm not sure on this one long term. I think it's obviously not going to go out of business anytime soon, but it could be, who knows, maybe a decade or so before it can take out all-time highs again, if ever. And in a similar story to Snap yesterday, Pinterest got crushed today. These little social media players not having a good day like the big guy Meta is. They missed on sales, beat on earnings, but also, like PayPal, issued a weaker than expected forecast. Revenue did rise 12% year over year. However, they're not doing as good as the big guys. With the broader digital advertising market showing recovery, Meta, Alphabet, and Amazon all picking up steam and growing their ad business by double digits in the fourth quarter. And there's a look at the daily chart on Pinterest, which had been in a pretty good uptrend with the rest of the tech sector these last couple of months. However, just looking at a 5-minute chart after hours here, getting quite a bit of volatility. Initial spike down, spiked back up. Now we're selling off again. Still down almost 10%, below $37 a share as I speak, which is a lot different from Meta, which is absolutely on a tear, holding ground after its blowout earnings last Friday. And we're still watching what's going on in the regional banking sector. Still got New York Community Bancorp with some troubling price action, trying to find a bottom here. And as usual, the street's now starting to bail on it. Looking at the daily stock price, looks like a small candle, but it fell 6.5% today. Did have a big hammer candle on volume yesterday. Let's see if it can hold. But remember, we even heard straight from the big kahuna himself, Jay Powell's worried about commercial real estate. He thinks it's a problem they'll be working on for years, and that its impact on banking has just begun. Apparently, they're working directly with some of these smaller banks, trying to get ahead of contagion and system-wide panic, because he knows the risks that are out there. And just diving back into the charts, there's the volatility index holding ground just below 13, with volatility risk premium still pretty low here, 1.8. Option dealers are pretty chill. Got the 2-year yield holding ground just above 446. 10-year looks to be consolidating as well, just below 420, with high yield bonds consolidating below the 50-day VWAP. The dollar index holding ground there. And look at Bitcoin starting to tick a bit higher here. You could think of crypto, especially Bitcoin, like a proxy for liquidity in the market, the real pointy end of risk on settlement, meme stock buyers, etc., etc. And so with what we're seeing in the semis and things like Supermicro Computer, Nvidia, that's spilling over into Bitcoin as well. Might come up and have another run at 50,000 soon. But we've also got things like shipping rates still in this really strong, persistent short. Looks to be moving into a medium term uptrend now. Still consolidating from gold. Agricultural commodities moving sharply higher. Another pullback today in Chinese securities. Got 1 day of trading left before we go into the Chinese New Year weekend. Got high beta stocks picking back up versus low volatility. Same deal with growth versus value breaking out. Very hard to be a value investor in this environment. There's small caps trying to find a double bottom relative to large caps, and a little bit of a tick up in inflation expectations. With the best performing stock sector today, actually IPO shares, followed by ARK, another one of the leading sectors, home builders, actually breaking out today to new yearly highs, with a bit of a pullback in the defensive sectors. Consumer staples and utilities still relatively weak as well. Let's look at Tesla, still trying to hold ground here and put in a bottom. However, I'm not so sure whether it can fill this gap down after earnings. The sentiment on the stock just seems really weak here, and it's definitely broken apart with its peers. There's a look at the proxy for a Trump presidency. That's his SPAC. And this is the investment vehicle that plans to purchase Trump Media, which owns his Twitter clone called Truth Social. That's absolutely ripped up this year, as the odds of him winning in November continue to climb, now with their significant lead ahead of the incumbent President Biden. And there's a look at some of the other regional banks we're following, along with the big financials as well, kind of consolidating here a bit and just waiting to see what happens next in the regional banking sector. As normal, JP Morgan's holding up the best. All right, guys, there we have it on the weekly S&P 500 chart, hitting 5,000 for the first time ever. Like I said, you can't argue with the technicals. Hitting new all-time highs does make it a bull market, even though it doesn't really feel like one, and we can still see a lot of risks out there. Shorting this is just very tough, like stepping in front of a momentum train, and who knows how high we can go before we have that inevitable blow off, which doesn't look like we've got just yet in these really hot stocks, but we'll be keeping an eye on them every day. That's all for now. Thanks very much for tuning in, and if you found some value in the show, please go ahead and hit that like button. I do appreciate all your support, and we'll see what the market brings us for the last trading session of the week tomorrow night. So come back to the Click Capital channel tomorrow night, and we'll dive in and I'll review all the charts and give you my thoughts and analysis on what's happening out there. Thanks very much. Cheers.